In this chapter, we're going to go over how to value a company. So there's really two main ways to do so. We talked about financial metrics, and those are all great. But how do we actually get a fair value number for a company? And the two main methods of doing so are through a DCF model and a dividend discount model. I'll explain both in detail. So a DCF model estimates the value of an investment or a company based on its future cash flows. It involves projecting the cash flows the investment is expected to generate over a certain period of time. These projected cash flows are then discounted back at their present value using a discount rate. The discount rate accounts for the time value of money and represents the investment risks and return expectations. The present value of each cash flow is calculated and summed up to derive the total present value. The terminal value is estimated to capture the value of all future cash flows beyond the projected period. The present value of projected cash flows and the terminal value are added to determine the investment's fair value. By comparing the fair value to the current market price, you can assess whether the investment is overvalued or undervalued. And I'll explain kind of an easy way where you can kind of get around, doing this complicated financial forecasting. There is models online. There are websites online where you can actually, basically do this with, zero modeling skills. Pretty much just inputting a ticker and, cash flows. And I'll dive into that in the end of the video. But you should at least understand the core fundamentals of valuing a company through a DCF, just so you understand what you're looking at, right? So, and this is kind of a good formula to look at. So this is the present value formula. So it's basically just cash flows divided by 1 plus the discount rate to the n, which is the number of periods in the future you want to be forecasting out to. And then for the discount rate, so the U.S. 10-year Treasury rate is the most widely used discount rate. Investors must compare future cash flows to what the risk-free rate is. Simply put, the return an investor can get from lending to the U.S. government is quote-unquote risk-free, and that is the minimum return an investor will accept, right? So just to give an example of this, analysts at Goldman Sachs put together a DCF model and project the fair value of ticker XYZ is $100. The stock trades at $98, therefore the expected return is only 2% for this investment. The 10-year Treasury yield is at 5%, meaning the U.S. government will pay 5% per year to investors that buy their debt. The expected return is 2% for X, Y, and Z stock over the next year, but the Treasuries are trading with a 5% interest rate, meaning you can get a 5% risk-free return from the Treasuries. What should Goldman do? Should they buy X, Y, and Z stock, or should they get the risk-free return from the Treasury market? Well, you probably guessed it. X, Y, and Z investment is projected to return 2%, but like any company, there are a lot of risks. The U.S. government has never defaulted in the history of the United States, meaning in theory, lending money to the U.S. government is risk-free. Therefore, Goldman will buy U.S. Treasuries, right? Why are they going to take a risk in buying a stock with only a 2% return when you can get a 5% return from the U.S. government with no risk? You're always going to, kind of go the route of less risk and more return, right? Even if they were even, let's say the projected return of this investment was 5% and the projected return, and the for sure return from the U.S. government was 5%. They're always going to go with the U.S. government, all things being equal, because there is no risk there. And then, rather than creating a DCF model for every stock you want to value, there are free templates online. My favorite is from CFI, which is Corporate Finance Institute.com. And you can see kind of how this is here. So all you have to do is type in what you want in the top left under assumption. So you just type in the tax rate, the discount rate, the growth rate, EV to EBITDA multiple, the transaction date, basically, when you're actually buying the stock, fiscal year end, and the current stock price, shares outstanding, debt, cash, capex. You could all find this on Yahoo Finance, all those numbers. So that is kind of how you get the fair value of a specific company. And then keep in mind, though, this template does not account for dividends. Therefore, if you're valuing a company with a dividend, the fair value is going to be understated. Just keep that in mind. But what if we were looking to value a company accurately with a dividend? Well, then we would use the dividend discount model. The dividend discount model is a valuation method used to estimate the intrinsic value of a stock. It focuses on the present value of expected future dividends. The dividend discount model assumes the fair value of the stock is derived from the dividends received by shareholders. The model assumes that the dividends are the primary source of returns from the investment. It requires estimating the expected future dividends of a company that they will actually pay to shareholders. The model discounts these future dividends back to their present value using a discount rate. The discount rate represents the required rate of return or the investor's expected return. By summing up the present values of expected future dividends, the dividend discount model calculates the intrinsic value of the stock. Comparing the intrinsic value with the current market price helps to determine whether the stock is undervalued or overvalued. The dividend discount model is commonly used for companies that pay regular dividends and have a stable dividend growth pattern. It is favored by income-oriented investors who focus on generating income from their investments. And then same thing here, you can find this on 365 Financial Analyst, so different source here, but same thing. You just type in the assumptions on the top left here, cost of equity, long-term growth rate, short-term growth rate, and the dividends that they had in the past year. So not really super hard to kind of figure that out, and you can see that you get a fair value share price on the bottom. So all that being said, that is kind of how you value a company. That's how you get to a fair value of a company, very easily, very simply. So I hope you enjoyed that chapter. Make sure you run through those quizzes as always.